Yeah, so credit markets have started to underperform. Credit spreads have started to widen. And in an average widening cycle, investment grade credit widens around about 150 basis points. So far from their tight valuations or their highest valuations since the GFC, they've widened about 30 basis points in the United States. So it's only just starting to happen. But investors should keep an eye on this space because it does tend to lead equity market performance. So if we think back to the last crisis, credit spreads started widening really aggressively in June, July of 2007. And equity markets went on to make their all-time highs in November of that year. So in a 3 or 4 month lag. Credit then started to perform really well and tighten once the policy responses had been kicked into gear in late 2008. But equity markets went on to make their lows in February 2009. So investors can get a little lead by looking at that credit cycle. I guess clearly as interest rates are rising, that changes credit quality for those that are low quality. That makes it a little harder for them to fulfill their obligations as those funding pressures rise. And this is something that's just starting to get going now. So I guess we've already had the interest rate move in many respects in government bond markets. But those credit markets are now going to, we feel, perform pretty differently from the pure interest rate piece. So it's very important that, again, in fixed income, people recognise credit risk is very different to interest rate risk. And they need to divorce the two and think about them separately. They haven't needed to do that for the last 10 odd years since the crisis because credit has had a huge amount of tailwind behind it via quantitative easing and lots of global liquidity. And that's been to the market's benefit, absolutely. But as we're taking those, those types of policies away from the market, it's something that investors need to give some consideration to and think about their credit exposures and do they really want to be exposed to those types of issuers and make sure they're very well diversified.